Welcome to the Swiss Money Secrets podcast, a podcast designed to cover all things offshore investing and banking from the Swiss perspective. Let's get into it.
I want to start with one point before we tackle everything else that you just asked, which is timing the market is generally not a good idea. So we will be talking more about what election years mean. There are some slight differences that we see, especially when we look at the US election cycle, that can be interesting to observe, to have conversations about. But at the end of the day, being invested is better than not being invested, and being invested throughout all trading days is better than trying to pick the right one. And the person who came up with this whole idea of having a US election cycle, that every year of a US election, so year 1, 2, 3, 4, we see different behaviors in the market. He's a person who believes in timing the market. He's also the person who came up with the Santa Claus rally, which some of our investors might be familiar with. His name is Yale Hirsch, and he has a different standpoint than us, I would say, in terms of believing that you can time the market. Having said that, there are some differences that we see, and generally speaking, the first year of the presidency is toughest on stock markets because the president usually is most open to putting tough measures right after he was elected, because the next re-election is still quite far away. So what we see is year 1 and 2 are fairly tough on markets, and then year 3 is generally a very good year, and year 4 is also still a good year, but a little bit more volatility can be seen there. And I think in year 3 is really when people start thinking about the next election, when people start having stronger opinions on whether they want to re-elect the person who's in office or not. So they're having a very ease policy in terms of having a policy in place that is going to be favorable to stock markets, makes sense from a president's perspective that wants to be re-elected. And then the volatility in year 4, I think that just comes from investors not liking uncertainty. And an election always comes with uncertainty, right? If you have a proper democratic election, you don't know what the outcome is going to be, and that's something that investors dislike.
Yeah, I think that's certainly a point. Is insecurity, no matter what it is, the markets seem to have a bit of volatility inside of that. So as you mentioned, no time in the market. I think we all sit here and agree with that totally. Or do you have any ideas, I guess, when it comes to people who might be nervous or whatever, how to move forward through market insecurities?
Yeah, sure. I mean, the election or the political side is one side of the medal, but there is also another side, which is the economic side. And I think it is very important to not lose your perspective and not lose the focus on what is going on economically in the world and in the country where the elections take place, because oftentimes, I mean, you can also not you cannot drive or steer the economy as exactly as you would like to. And so I think that it is important to look at the investments you would like to take into your portfolio, and no matter what is going on politically, even so it could have an uptick or down or going down for some time, that you look, okay, is this investment considering the overall economy, is it worth buying it? And is it worth it the long term?
I think that's a very important point to bring in, the long-term nature of investing. So for us, we have an extremely long time horizon for most of our clients, and this is something that, yes, it can be affected in the short term by political cycles and elections in the US or other markets, but it's important, I think, to have discipline and keep the time horizon in mind that you have planned for your portfolio, and not get too sidetracked on what's happening in the short term.
Yeah.
Yeah, go ahead.
And I mean, even so, I agree that timing the market over the long term not works very well. I think there are some environments or some situations where it might be beneficial to hold back for a certain time period. But again, it comes to the evaluation and the priciness of the investments themselves.
Yeah, it's not talking about timing the market, but understanding paying a fair price
Correct.
for the investment that you're looking at.
Yeah.
And I think that can get confused sometimes,
Yeah.
especially when talking from a professional investment standpoint to a private investor who even has good knowledge. If they hear an investment advisor say, yeah, we're going to wait right now, it's not really the right time, but then they think, oh, they're trying to time the market. But actually, how we could communicate that better is, hey, the price isn't really at a fair price or what we think it should be valued at right now. And so we're going to keep it on our radar, continue to monitor it, and maybe even adjust our evaluation. If the company has seemed to hold that price, well, maybe there's something that actually means that we need to readjust our value. And so it doesn't mean timing and the timing of it, but actually looking at the right price for something.
Yeah, correct.
And I mean, we are never not invested at all, right?
Yeah.
I mean, it's always an ongoing process where we have certain investments, we're looking at adding more. And I think when we talk about timing the markets, it's also like, I have this $100 and I'm going to wait for the perfect time to go into X investment. Whereas with us, it's like, okay, we have a little bit of allocation in currencies, a little bit in bonds, maybe a few stocks. And now, is this stock at a fair price right now to add it to the portfolio, or should we maybe look at another stock? But I think when it comes to the time horizon and the whole presidential election, another thing that's interesting to note from one, like an outsider perspective as a Swiss person looking into US politics, but also from a statistical point of view, is that Americans in statistics tend to severely overestimate the power of the president and also severely overestimate the party allocation. So whether like they overestimate how good the representative of their own party is going to do and how bad the representative of the other party is going to do. And I think that's something, when we look back, especially at like fiscal decisions, when it comes to government spending and when it comes to devaluation of the US dollar, this is something that we have seen over various previous politics from both sides of the aisle. And this is something where personally, I don't think we will see a change irrespective of who's going to win this year. And this is something that people need to take into consideration, maybe focusing less on like which specific person is going to be in office and what specifically that means for stock markets, but rather think more about what is the generic direction that the US government is going to take, and is one single person really able to change that? Are the incentives there? To reduce government debt? Are the incentives there to try to give more value to the US dollar again? And there personally, and you're happy to join in if you disagree, I don't think that's going to change, irrespective of who wins. And that's something that people need to keep in mind when constructing a portfolio. And that's, I know we might sound like broken records, but this is something that we very much consider when constructing our portfolios, that we see this long-term devaluation of the US dollar and that we want to diversify out of that and build something that is built on currencies and economies that have more of like a value appreciation potential.
And a sustainable approach to running their economy and holding the value of their currency. I think that's the other side of it. We have recently, Urs and I have started a little mini podcast that is put out every Friday, where we look at the market data of the week that we just had and what data points we're looking at moving forward. And last week, what was interesting was we were looking at some of the job market reports of 2023 in the US, and it was that job markets increased. There was more employed people than unemployed people. They created jobs, and that looks like a great macroeconomic sign for the country. As we dove deeper into those numbers, it showed that over 50% of the jobs created were either government sector jobs or highly subsidized government sector jobs. So again, that whole picture of what you were talking about, Urs, is look at the data points, what the economy is doing and how that economy is being driven, in what direction. And Jamie, to your point, I agree. I don't see either side really doing much different. I mean, in 2023, we saw the U.S. get downgraded by multiple credit rating agencies, and that's a huge deal.
Yeah.
I don't think that's something so small.
No, I think these are like structural trends, and it's not easy to break them. Oftentimes, it is like the regulators just come from one perspective, where they say, "Oh, that's a bad thing." We have seen, for example, in 2016, the Panama Papers, which like hugely pushed this topic and the willingness to go into this direction, but it's just like a very, very small part of people who might not behave in the right way or like misuse it for their like anti-money laundering stuff or so. And there is a huge amount of people who rightfully use these structures to plan and structure the wealth.
Yeah, I have a little bit of a different viewpoint because I don't think that politicians don't understand it. I think they understand it very well, and they just misuse this worry about money laundering and terrorism financing for a huge data fishing expedition. I don't think that the problem is that they don't understand the value of privacy or whatever. I think the problem really is that they found a loophole, that they can gather more information, that they can gather more data. I mean, I've been at the Heckerling conference in Orlando, which is one of the largest estate planning conferences in the US, and I spoke to a lot of attorneys because obviously we are not attorneys, we're also not Americans. And many of them were extremely worried about this just being the tip of the iceberg and this being like sort of pushing a door open to just ask for more and more and more information, because the governments, if there's illegal activities or if there's any like reasonable suspicion for illegal activities, the governments already have the information or can obtain the information. So it seems extremely shady to me to say, well, we now need a almost public register where all the information is being gathered, because it just lumps everyone, as I said, it just lumps everyone into this suspicion category. It's almost like we are suspecting that you do something wrong unless you like prove that you don't, instead of the other way around. And the other thing that I think is very important is also what you mentioned, that a legitimate public interest could be anything. It could also be journalists who are just looking and fishing for information. We're here in Switzerland, we have a very notorious list of the richest 300 people that comes out every year, and it's sometimes a bit questionable how the information is gathered and how they come up with the numbers. So I think from our side, and we probably speak for the majority of our industry, we have very probably strong feelings that this is not a great direction. But the problem is with the FATF and the OECD being so having so much influence, if you refuse to implement it, like that's something that was discussed in Switzerland, if you're being blacklisted or even just grey listed, your financial industry is destroyed. Like you can't really do a lot of international business anymore, and you're most likely not going to recover from such a listing. So you don't really have much choice of implementing it. The only choice you have is how you're going to implement it and how much you involve the actually affected people, or the professionals who work with the affected clients or not.
Yeah, and I mean, in all of this discussion, it's also the question, I mean, where is the protection against the government? You never know how the government develops, and if they have all the information, I mean, you mentioned it, they already have a lot of information, but if they have more and more information, I mean, where does it stop, and who guarantees you that they're not going to misuse it for their own interest if they need money? I mean, we have the highest debt to GDP ratios around the world in Western economies, which is ridiculous, and in some way or the other at some point they have to cut their costs, they have to cut their debt, and who knows what is going to happen.
Yeah, I think that's one thing that I find interesting, especially the exchange of information. When you look at it from the US perspective, there's a few people who can actually access the registered list, to the beneficial owner list. It's not open to the public, but it's to almost all governmental agencies, as long as they go through the proper lines to obtain information. Foreign governments as well as foreign tax authorities, U.S. tax authorities, state, local, and tribal authorities in the U.S. And so it's in terms of who's going to be looking at this, well, essentially all the government agencies in the U.S., for example, will be able to get the data. And so it's even something you lived your whole life, as an example, in Colorado, but states from Alabama can go and get information on you. And that is concerning. And I do agree, who does protect you as an owner and your privacy and your information when the government has it and you don't have any control of what the government gets to do? I think another point on this is, who is excluded in the US, for example, from reporting to this list.
Yeah.
And there's like 23 categories that are excluded, and one that kind of I think is shocking to see in quotation marks is large companies that operate within the US. That's where all the money is. So that means all these small LLCs, these medium LLCs, these small businesses, they have to do the reporting. So as Jamie, you said, it's this data fishing ability on not just big companies, but small companies. Now, some of the reason that they're exempt from reporting is because they're already on so they're registered with the SEC, or they already have this data given to the government, but now they're going after everyone else. And that, for me, is the most concerning.
And it also just creates more administrative work, and then essentially also more cost. And that will have to be passed on to the consumers, to the clients, and
to the people also.
Yeah, also to the people. I mean, it's also going to cost more on the government side, right? Because someone has to maintain the register, someone has to look up the information. But to maybe move a bit away from the negative, I think what is very interesting is we have now this Corporate Transparency Act or Beneficial Owner Register, however it's called in different countries. And we have this very nice comparison of how the US implements laws, how the European Union implements laws, and how Switzerland implements laws. And I think this is once again a sort of case study of showing how the Swiss direct democracy is different, right? On paper, all three, the European Union, the US, Switzerland, they're all democracies, but they work very differently. So we already heard the European Union, they were the first, they just ran with it, they completely overshot the target, they made they constructed something that didn't make sense, that was going against the human right to privacy, and they have also been, I believe, I'm not sure if they have been fined, but they were definitely told off by the European Court of Justice that said, well, you can't do this. So they had to move back a little, downsize their whole operation. And then the second in line was the US. That was a little bit less extreme than the European Union. I think they never had a publicly available register, but they still just had register and did what they wanted to do. And then last in line would be Switzerland. And as of today, we don't have the Corporate Transparency Act or a register here yet. We're working on it, so we're not going to say it's never happening here. It will come as well, because Switzerland does not want to be black or gray listed. But we take our time more. And what I find extremely interesting, and something that our American listeners might not really be aware of, is if Switzerland starts the process of writing a new law, they have a phase where they invite the whole public to respond to it. I don't know what the English word for it is, but it's essentially a couple of months. It's typically around half a year or so, where every company, association, and even private citizens, everyone who wants to say something can say something and write to our executive body, which would be we have 7 presidents, so you can write to their offices, and they will gather everything in one folder. And then they will look through it and work through it.
Do we have any final thoughts?
I would say, it's very encouraging how Switzerland moves on topics like this. There will always be some changes on the regulatory side coming in. There is a lot of interest to make things more to adjust things to each other so that every country, every jurisdiction has the same rules. But at the end of the day, it's good to know that we have a say, that we can interfere with things that are probably going to change in Switzerland, and we will take it seriously. We will do whatever is in our power to protect our clients' interests.
Yeah, I fully agree. I think that's a very nice final word. I don't really have anything to say other than it's just important that people stay up to date on what rules and regulations are being put in place, and that they stay critical, and that also I'm a firm believer of voicing your opinion. And even in the US, if you cannot directly get involved in the lawmaking process, write your local politicians and tell them how you feel. I do believe that is something that makes a change, and the more people voice their opinion, the fairer and the better typically the system is going to be. Yeah, and especially when it comes to like the portfolio management, I mean, you need knowledge and understanding of how to prompt it. I mean, the checking is very important, but you already need to have a certain level of understanding in a topic to create meaningful responses. And I think that's also, you mentioned robo-advisors, which I actually wrote my final thesis on in university. And back then it was like a big hype and everyone thought like, oh, wealth managers are going out of business and this is it now. But people, when it comes to their finances, it's such an important and such a personal topic. They want and need another human being that they can trust. And even if that human being works with technology, uses computers to assist, uses models or AI, or back in the day Excel to exist, whatever it may be, people want to work with people. And I think this is not going to change. I think most in our industry would agree that that's not going to change. I would think most of our clients are going to agree that that's not going to change, especially in the business that we are in. If you're in cross-border wealth management, or if you have another niche specialization, it's not as easy as just putting an ETF into a portfolio. You really need to have a good understanding of the regulatory framework. You need to have a lot of experience. You need to have good contacts. And again, while I think certain specific tasks can be outsourced, it all has to come back together to a human being, to a person who's available to do a little bit of hand-holding when things are a bit tough, to explain questions, to just be there, show empathy. I think our job goes way beyond just putting together a portfolio. It's about helping people sleep better at night. And for myself, I think if the only contact person I would have would be like an algorithm, that wouldn't necessarily put me at ease very much.
Yeah, definitely. You see it already these days. I mean, with many big corporations, I mean, as long as everything is fine and good, there is no issue at all. And they sometimes have their chatbots, which are also run by artificial intelligence. And as soon as you have an issue, I mean, they are useless.
Yeah.
And it's really bad. It's so frustrating.
Yeah.
And especially in wealth management industry, I mean, these are like individuals that have or that worked hard for their money. They achieved something, built something up, and they want to have this individualistic solution and want someone to take care immediately if something comes up.
Yeah, and also take responsibility.
Yeah.
Sometimes it also helps if you can share your frustrations with someone and have someone, like, for example, apologize to you. A computer can't really do that. And I think another very important topic that we haven't really discussed so far is all of the regulatory concerns and the privacy concerns. I mean, we now currently at WGP, we use some generative AI for things like creating some content, for example, or summarizing some concepts in an easier way. But we never use it for anything like client related. We never use it for client data. We never use it for anything portfolio related, because there we have to be very careful who owns the data, where does the information go through. We here in Switzerland, but particularly also in our company, have very high standards when it comes to cybersecurity and privacy protection. And just right now, if you don't have like an in-house solution that was programmed by yourself, where you know where the server is, where you know who owns the data and the information and all of that, we don't feel comfortable using AI for anything that's related to our core business, and I don't think that that's going to change anytime soon.
Yeah, and I think that brings up kind of that further the risk factors of using AI, as you mentioned, you know, where the data is going, where it's being used, and at the end, to have a really good grasp of that, you have to be or have a pretty strong understanding of coding. So that if you were to use an AI, and even if it was an external, say an AI assistant for some back office stuff, you need to be able to understand the code so that you know, is there any siphoning of data?
Yeah.
Are there any loopholes that we're missing here in our contracts? And so there has to be, you know, a very kind of deep understanding. I think the general public doesn't have that. And so that's going to take some time for implementation in the long run in general, even if companies who are offering these, are very straightforward, that's always a risk that you have to play with, a bad actor in that company, whatever. And so those are challenges that AI presents just in the working context of how much responsibility can we trust? Because at the end, this is a trust business. As you mentioned, that person wants that connection. The chatbots, I never use them because they, as you said, they're always useless. Whenever I see a chatbot now, I ignore it. I don't. It's like an advertisement. I don't care about it at all.
Yeah.
And I think it's become kind of the new automated voice answering machine that these big corporations have. And personally, when I get an automated voice message or I get a chatbot and there's nowhere for me to talk to a person when I'm trying to solve a problem, I don't want anything to do with that company anymore. And so I think on that side where AI certainly has benefits, it's a tool, and it will, for the foreseeable future, especially in wealth management, be just that, just a simple tool.
Yeah, and I mean, for us, we have such a high emphasis on knowing our clients. Everyone, like, we're a team of 5 people, 4 of us have regular contact with our clients, and we know all of our clients. We know the backstories, a little bit about their family, even if they're not our clients, because sometimes we're on our vacation, someone's on a business trip, and if someone else picks up the phone, we know who we are talking to, because we know how important it is to have the personal connection, especially in a business where we are physically quite far removed from the client. So we wouldn't want to have additional burdens of making it less personal. We want to be there for our clients as human beings, for them as human beings, and a chatbot or anything like that would just severely interfere with that.
Yeah.
We also consider ourselves part of the financial sector. We are an independent asset manager. There's about 1,500 other firms who are similar to ours. There's insurance companies, there's a variety of other SMEs that consider themselves to be part of the financial sector. So we are really talking about a very small and specific part of our industry when we talk about the too big to fail regulation.
Yeah, and I think that's a really good picture of understanding just kind of the scope of Switzerland. I mean, the financial sector in Switzerland is quite large. They employ over 100,000 workers throughout the country. As you mentioned, just in what we do in terms of wealth management, there's over, I think, you said 1,500, but I think it's closer to around 1,600. And so you're talking like, yes, this is these 4 banks, and they do hold a huge, I guess, value of that share, but there's so many other strong and banks that pose less of a risk. And if those banks were to face challenges like what we saw with Credit Suisse, there's huge room for these other banks to grow and take on, and so that you don't get those bank runs, or it's a slow move to be absorbed by all the other banks. And I think that's something that's really important to see, because these other banks also don't operate like a Credit Suisse or a UBS.
Yeah.
I mean, even those other banks you mentioned, like Raiffeisen, Postfinance, and Zürcher Kantonalbank, they all function quite differently from each other, first off, and different from like the big kind of corporate Americanized, I guess we could say, bank that UBS has kind of become.
Yeah, and we find it important to talk about it for like financial literacy reasons, because it's an important aspect of the banking world to understand. But we as WHVP, as a company, we don't really work with those huge institutions, because we do like to have companies that are more entrepreneurial, that are more focused on like one niche service that we are looking for, that are family owned and managed. So I'm not saying that large banks are bad per se, not at all. I mean, they also serve a very important function, but we tend to look for different things when we are working with banks. And I think that's the beauty of our ecosystem, is that we have such a huge variety of experts and expertise in so many different institutions, and then you can sort of pick and choose who you want to work with and who best represents your philosophy, your beliefs, your needs.
Yes.
You were looking, I feel like I'm talking all the time. You were looking like you wanted to say something.
Yeah, I did want to say something, because I think there is an important distinguishment which you have to take into consideration as well when you talk about these important banks. There is like the systematically important banks on a domestic level, but there are also systematically important banks on a global level. And I think that is a very important difference between, as you mentioned, Raiffeisen and the other banks and the Credit Suisse or UBS, because as we also have seen and what was also communicated during the news and media is that before there was a solution or this takeover from UBS or Credit Suisse taking over UBS, there was also quite a bit interest from other governments which were worried about what would be the impact on Credit Suisse failing.
Yeah, I think UBS is now the only globally systemic relevant bank that we have left.
Yes.
And we have to look after it carefully. So I think personally it's a good thing that the Federal Council has now critically looked back to this acquisition. The government is not involved in the transaction anymore. They have been a supporting factor in the early days. They have helped facilitate the solution. They have given some guarantees that have been paid back in the meantime. However, I think it's also important that we keep in mind what we have discussed before, this variety and all those other actors in the market that are just in a very different situation than UBS, and that we don't overshoot with regulations. Because in Switzerland, we are in a place where all institutions are very well regulated. We have very good and solid laws. Clients, in my opinion, are very well protected, and that's a good thing, that's important. But we also cannot make it so complicated that clients don't understand all the paperwork anymore. They don't understand all the rules and regulations anymore. So when we look at this report that came out, the Federal Council tried to sell it as like this big movement towards more safety and security, and they have like 22 measures that they're going to put into place. But if you actually read through it, you see that there's not gonna be so much of a change. And my feeling is that the broader public is really worried about the UBS situation, which I think is valid, but they're sometimes missing a bit this nuance when it comes, or this broad spectrum when it comes to other financial institutions. So for me, this report was pretty good, like balanced strike of saying like, yes, we're taking this seriously. We have looked at what has happened. We are making sure that we will make improvements, that we have measures that we can take to protect our economy, but at the same time, not changing everything, not making things extremely more complicated and burdensome from like a regulatory and compliance side.
Yeah, and I think it's an important point you're raising, and it's also, you cannot cancel every risk. And also with Credit Suisse, it was not a huge surprise that they went bust. I mean, it was a surprise at that specific moment in March 2023, but there was like a chain of events before this event happening. And at the end of the day, you also have to ask yourself, okay, who is in charge? I mean, it's not only the regulatory authority, it's also the shareholder who had to say something, who didn't say anything at all, and there also has to be the client. And so, as Jamie said, we are very picky when it comes to the banks we work with, because for us it is important that it is sophisticated enough to it makes sense to work with these people, but also easy enough so we can understand the structure and we can understand and evaluate the risks our banks we are working with are presented to. And so you have to have a more holistic view about that and not raising your voice and saying we need more regulation, because the regulations are not the issue. The issue were that there were corporate governance issues that were not taken care of.
Yeah, I think that the larger institutions, you have managers that oftentimes lack integrity. And I think that's something, I mean, we have had conversations about that. You cannot regulate integrity. And I think it's important that as a financial industry, we also show up and show that we have companies that are entrepreneurially run, that are run by people who put their own funds in, that take a huge personal financial risk, that are run by people who have that integrity, who have proper risk management, because they are also like managing their own money with the financial institution. And I think that's something where we have to be, well, beacons of light, that I guess, and hope for the broader public, because I think people have become a bit fed up with those excess payments and like all those too big to fail discussions that we're having, that the government has to step in and save everyone all the time. Like if there's an upside, you take it in your own pocket. And if there's a downside, the taxpayer has to pay for it. And I sympathize with that. I do understand it. It frustrates me too. But again, this is not all the financial industry has to offer. And I think that's very important to really keep in mind, that the vast majority of all players are doing a very good job. They're paying taxes, they're creating jobs, they create a service that is needed by the economy, that is needed by the society we live in. And that should be the focus, in my opinion, to not just always talk about the very few bad players, but talk about everyone that is doing a good job, that is helping families, that is creating financial stability, and that is offering a service that people want and need.
Now, if we look at the 1960s to where we are today, we see a cumulative inflation on the US dollar of about 955%. This incredible number.
Maybe we want to zoom in a bit on like the past 20 or 30 years, which is more or less the time frame that our clients had to build their wealth, and also from our side, that's like the time frame that our company has been in business. And I think there has been quite a lot of change and movement in things relating to the US dollar value just the past 2 or 3 decades. Especially one thing that comes up very frequently is just the levels of debt that the US has. So that's something that we saw increasing in the mid to late 90s, and it has only accelerated, and it severely accelerated during the financial crisis. It severely accelerated during the pandemic, and correct me if I'm wrong, but I think for both Democrats and Republican presidents, we saw an increase in debt, and that's something that certainly leads to a situation where the government or the whoever is the administration is at the time being doesn't really have an interest in regaining the strength of the US dollar. And I think another topic that we can talk a bit more about, and I think you probably both of you have something to share about that as well, is just how other countries and other like power blocks are seeing this weakening in the US dollar, and how they are like spying or looking at this opportunity that they can build some sort of alliance or some sort of currency that could challenge the US dollar as a reserve currency at some point in the future.
I mean, in general, the world is developing, and there are more countries that have reached a stage where there is a certain level of wealth present, and with this certain level of prosperity, there are also more demand for having a say in the world order. And for the US, especially with what was going on during the Second World War II, I mean, America was the saver back then, and they thought, okay, we will have this status forever. But as long as it went on, there were other countries saying, okay, we want to have a decision in everything that is going on. And as long as the US was involved as heavily and also had their laws forced onto other jurisdictions through the US dollar, they started to realize that's not going to happen that easily.
I just wanted to say that like the whole topic of diversification, we're not talking about this from a country perspective,
Yeah.
but it's also a nice segue to talk about what individual people can do in terms of like the US dollar devaluation. And I think it's important to note that if you live in the US and you earn and spend and think in US dollars, that even though the US dollar is losing value in the long term, I wouldn't say it makes sense to divest from it entirely, but there as well, a strategy of diversification can make a lot of sense, be it through precious metals or foreign currencies or a foreign bank account, just to be taking into consideration that maybe for your long-term capital preservation, your savings, your investments, you might not want that entirely exposed to the US dollar.
If we look at the Swiss franc to the US dollar in terms of appreciation, again, kind of taking that 1960s to 2024, I mean, in 1960, with $1 US, you could get almost 5 Swiss francs. It's like 4.9 Swiss francs. Today, you can't even get 1 Swiss franc with $1 US. So you have all of that appreciation there where these currencies appreciate. In the Swiss franc, it's obviously been a long-term sustainable appreciation. It's been incredible to see with their debt break how they've managed that and how they've also run surplus most of the time. Of course, there's years where they're in deficit as a country, but in general, there's a reason that the Swiss franc has appreciated. It's not just because, people want to have Swiss francs because it's outside of the US and it's the place where you can hide your money. That's not the case. It's the management of the economy. It's the management of the price stability that the US has essentially thrown to the wind to a certain extent, where other countries like Switzerland have had to really play and make sure that their economy remains stable for the long term.
The only thing I can say, we talked about the last 2 decades. If you would have moved US dollar into Swiss francs 20 years ago and would just kept the Swiss francs, you would have the same amount of US dollar today. So it is, or the same purchasing power today.
Essentially, for every single scenario, for every single candidate, spending is going to go up. The long-term trend and the systemic problems that we see in the US. Essentially, our stance as a company, and also my personal opinion, is that people get way too lost in the noise and the short-term panic that is being caused by the media and the candidates themselves, and that they lose track a little bit on the long-term direction. Because all the systemic economic problems that we see, and that's overspending, so an increase in the national debt, very high interest payments. So I think interest payments are now the biggest part of government spending, which is just insane.
This year they overtook defense.
Yeah, that's just
wild.
Crazy.
Yeah.
And then also there are various funds that are running the risk of going bankrupt over the next few years. Yeah. And I think those 3 main topics, and I think then as like a sort of side topic, we can also talk about the currency devaluation, which is one of the symptoms and consequences of those structural problems. They will stay bad and get worse irrespective of who wins.
The spending has always went up, but they were able to keep the debt levels at a certain point. But then you start to see, really in the 2000s, a little bit before, in terms of spending, it really skyrocketed, started in the Reagan era, and that's where the deficit really started going up. But what we see out of a deficit, you can have debt as a country.
Yeah,
of course. There can be positive impacts on the economy, on the population, with even a fairly high amount of debt. I mean, I think it's up to about 72 to 75% of debt to your GDP can actually improve the economy and life and people's life. But the moment you go above that, it starts to weigh on the economy and drag things down. And we've seen that in our lifetime especially, absolutely skyrocket in the US. And so I think it's been a long time, and so people kind of have gotten used to just debt increasing. But I think we have to try to really impress the point that, hey, no, there is a way. They were at a very similar debt level post World War II.
Yeah.
And they brought it down.
Yes.
And so.
And we're not in a world war right now.
Correct. But my point is, they've had high debt before and were able to bring it down.
Yes.
Now, it's a much longer conversation about how they got that debt level down. But it shows that there is the potential for the US to have this healthy level of debt, and it can be accomplished.
Yeah.
But that's the issue, as you were mentioning, that we do not see in either candidate a willingness to slow spending, or at least try to do things that will actually bring that deficit, because that's the biggest issue. Is that they're just going to let these, whatever, tax cuts or tax hikes, they're still letting the deficit continue up. Excuse me.
You already mentioned that there's a trend away from the US dollar, and we see that when we look at the reserve rates that central banks around the world, how much US dollar is being held. And when we look at the numbers over the past 10, 20 years, that has gone down pretty significantly. We're still at about 58% or so it's still high. And we're not saying the US dollar is going to collapse or become irrelevant next week, but it is a downwards trend. And I think this is the tricky thing with slow movements in a negative direction, right? I think everyone waits on a dramatic collapse or like a dramatic change of everything, but I think much more dangerous is the small steps in a bad direction. It's like with the frog where you put him in.
I was thinking of the same analogy. I was coming with it next.
Yeah,
but you got there first. Yeah, slowly raising the heat.
Yeah, just slowly raising the heat, slowly raising the heat. And if you put the frog into boiling water, it's going to jump out.
Yep.
But if you just slowly increase the heat, it's not going to realize it. And I think that's what's happening with a lot of the economic directions that the country is taking. And that's, to me, a lot more worrisome than the sensationalized short-term stories that the media loves to put out and to discuss and put on such a pedestal, where to me, it's just a distraction from much more serious underlying problems that are just slowly getting.
The Senate has a fairly strong majority of Republican senators, 53 seats. The Senate are held by Republican senators. And then there's a very small margin in the House. As everyone knows, American politics are extremely polarized, and so being able to unite a party to get the votes necessary for passing any sort of legislation, it's a very large effort. Typically, as U.S. tax legislation goes, to pass tax legislation, it requires 60 votes in the Senate. However, back in 1985, actually, there was a senator by the name of Byrd who passed a special rule which allows the U.S. Senate to pass tax legislation with merely 51 votes. So basically, that means that there's quite a margin that the Republican Party has in order to get some sort of tax legislation done. The catch is that in order to use this mechanism, what's referred to as reconciliation, the tax legislation needs to be revenue neutral. That means that any tax cuts have to be offset by tax revenue elsewhere. And so for this reason, we've received a number of inquiries. It's a very popular topic here in Switzerland. Do we think that there could be an end to taxation of Americans abroad? Could there be a change to residency-based taxation? And I think as a firm, we're a bit tempered in our expectations. Just to kind of give everyone a sense of where the U.S. deficit is currently, it's around 55 trillion, the U.S. deficit. And the current projections by the Congressional Budget Office are that extending the Tax Cuts and Jobs Act would cost somewhere between $4.5 and $5.5 trillion, adding that to the deficit. And that's without considering certain other promises that were made. So point being, in order to use this mechanism of reconciliation, they would have to find revenue elsewhere. So things like ending taxation of Americans abroad, they would have to find a pay-for provision, and it's simply not an easy thing to do. In terms of timing, I'm sure that the Republicans will be hard at work. They're much more organized this time around with this administration as opposed to the first time that Trump took office in early 2017. So I think that the legislation the public will be much more keyed in. There'll be much more movement next year in 2025. And I think the party as a whole will be much more organized. But I think the Republicans will also be very motivated. There's going to be midterm elections in 2026. And I think the difference in 2 years is that 20 Senate seats for Republicans are actually up for re-election, whereas only 13 seats for Democrats are. So the Republican Party really needs to be motivated, needs to move quickly to get their tax agenda pushed forward.
The first 14 million roughly of your net worth would be fully exempt from U.S. estate tax, which at the moment is 40%. So that's quite high. So that's probably, I'd say, the largest talking point within the TCJA at the moment, because there's been a lot of planning occurring with the assumption that it's going to sunset and go back to its original 5 million pre-inflation, which they're guessing right now could be anywhere in the 6 or 7 million range. So for people that maybe have assets above 7 million, but maybe below 14 million, you're really in a spot where you kind of want to act quickly. People now are maybe saying if it does get extended, there's no real urgency, but personally, we like to kind of be conservative and say, hey, you want to lock in, the guaranteed exemption today, because the IRS at least has announced, or at least Treasury's announced that there is going to be no clawback on that. So if you do utilize any of the exemption, the higher exemption today, and then it gets reduced, you're still okay.
Yeah, so they're not going to come back asking for tax dollars over in that 14 million mark, whatever, if it's 6 or 7 million, they're not going to come back asking for it.
Yeah, that's right.
Yeah.
It's a really interesting point, though. The Republican think tank that's authored a lot of the policy and the publication that we know about, even though President-elect Trump has not specifically endorsed it, called Project 2025. They published a very detailed manual on specific tax provisions that they thought would be interesting, and as concerns the lifetime exemption and estate tax, the text that's in there is simply to reduce the estate tax percentage, but the exemption would not necessarily be as generous as it is today. So point being, if you are in the 7 to 14 million range, it's possible that you won't do any better. Now's kind of the time where you can kind of optimize if you're looking to pass assets to the next generation.
Yeah, that's interesting. And I guess on that, do you think that there's going to be a concerted effort? I don't know in super detail of Project 2025, but do you think that they would be more likely to go in reducing the percentage, or do you think Trump is going? I mean, he is a billionaire himself. Obviously, 14 million doesn't mean much to a billionaire. I mean, it does mean something, but do you think the likelihood of that being extended or the reduction of percentage paid on the inheritance is more likely to come about?
Yeah, if you think about the way that those numbers probably affect Americans, if you already have accumulated, let's say, 7 to 14 million of net assets, then you're doing really well. You're not really, you've exceeded the middle class. But I think for the ultra wealthy, having a lower percentage estate tax rate it probably moves the needle more for you than having that additional exemption amount.
Yeah. Okay. That makes a lot of sense. And I guess from this, is there anything that you think that extra should be brought up, or should we kind of move on to, okay, let's get down to the bread and butter of how do I move forward as a person? How do I strategically make sure that my structuring is in the right way for my future? Do you have any points that on the U.S., like in terms of the Trump administration changing things, or do you think that we should, talk about how you can, I guess, strategically approach that kind of process of ensuring that you're going to get the most out of everything?
There's a famous physicist from the 1920s called, he was named Niels Bohr, and he coined the phrase, prediction is difficult, especially when it's about the future. So I think our view is that we would recommend relying on the rules that we have now. The rules that we have are actually the most generous that we've ever had in the history of U.S. tax law. And so sometimes, or I think most of the time, certainty is more valuable than fairness. So if you have certainty about a plan that's beneficial for your family's wealth and being able to do some planning, then I think to us that's probably the best way forward in 2025. And then I think in 2025 we'll start to kind of learn more. We'll kind of probably see bills come both out of the House and out of the Senate. So we'll start to get an idea of what that looks like and what the Republican Party internally has negotiated at each of the houses within Congress. But again, I think that they have probably until the end of 2026 to actually finalize the legislation. And so long as they sign it into law by the end of 2026, it can be effective January 1, 2026. Unclear exactly what we're going to see happen in 2025.
Yeah, okay. And in terms of, I guess, looking at an estate that's in the US and an estate that's abroad, what are some of the strategies that you guys would look at in terms of making sure that they are, let's say, a client of 7 to 10 million, making sure that they're actually being effective with their tax strategies?
Yeah, the U.S. is kind of an interesting place in that Americans are taxed, subject to estate tax on worldwide assets, but even non-Americans are actually subject to estate and gift tax if they have property located within the United States. So I think it's incredibly important that folks be aware of it, make sure that that they have the right advice, the right advisors on the wealth side, on the tax side, so that way they're prepared for whatever outcomes kind of wait for them, either in life or at death, and that they're kind of prepared to transfer assets to the next generation, whether that's setting up a trust vehicle or setting up some sort of a legal entity. Incredibly important for families who are operating small businesses, closely held businesses, how to pass business interests on to the next generation. A lot of entrepreneurs want to transfer assets to their kids and to their grandkids, but they want to continue to be involved with the business. They want to continue to have control of day-to-day operations. And I think all of that kind of factors into really a comprehensive plan that makes sense from a wealth planning perspective as well as from a tax perspective.
Do you guys have any kind of final thoughts that you want to give our listeners?
Yeah, I think kind of what we've talked about is there's still a lot of unknowns ahead of us. Obviously now with kind of, the Republican Party having, their foot into all levels of the government right now, there's maybe a larger likelihood that maybe things go their way, but I still don't think it's going to be kind of a smooth, easy process for them. So what we do know right now, at least, is, the Tax Cut and Jobs Act is going to expire the end of 2025. So I would probably still proceed with kind of planning according to that. Of course, later on, if it is extended, or if some of the items are extended and some are not, then you can kind of reassess and deal with it then. But in the meantime, what we know now is these are the rules, and that's kind of what we kind of recommend to follow.
Fully agree.
Thanks again for joining us on this episode of the Swiss Money Secrets podcast. If you would like to learn more about WHVP and what we do, check us out on our website at whvp.ch. Or you can check us out on any of our social media handles on LinkedIn, Facebook, YouTube, or Instagram by simply searching WHVP. Have a great rest of your day.